All right, everybody, it is time once again to lift open the hood of my 100% CoveredCall ETF based portfolio to check out asset allocations, price performance, total return performance, how income has grown month over month. And we're also going to look at, as always, towards the end of the video, tangible use cases for a 34-year-old married with 3 kids. What on earth am I doing investing for income? Well, stick around, you're about to find out, and hopefully you uncover some gems along the way. So let's get going. With all of these overviews that I do, I always want to establish what exactly am I invested in and what are those proportions. But even before that, we also want to establish why am I even invested in CoveredCall ETFs in the first place. Now, I'm sure many of you have heard of investing in low-fee, broad market-based ETFs, like an S&P 500 style ETF. And the idea there is, these are great for people who just want to participate in markets, maybe don't want to put a whole lot of reading effort into learning about finance, but it is a way to just participate and get your money working for you. Now, with a strategy like that, it is what we would call a total return type strategy. If you believe markets are going to go up over time, basically all your returns is locked up in that share price, but because it's locked up in the share price and you're going to hold it for long term, those dollars that are gaining are not working for you. So my approach is actually very similar to that. I like investing in broad market based funds, indexes like the S&P 500, NASDAQ 100, but I do it through what are called CoveredCall ETFs. And to just keep it really simple, because there's a lot to get to in this video, basically more of that return that you would see in prices actually just paid out to you on a monthly basis, which means you can buy, depending on what market conditions, you can use that money to reinvest continually, dollar cost average, buy the dip, whatever's going on, where you can't necessarily do that with the total return approach. Yes, CoveredCall ETFs, typically their management expense ratio is higher, especially if you're using leverage, but you have more flexibility with that portion of the return that's coming back to you. And we're going to get to performance of my portfolio very quickly here, but that's basically why. It just gives me flexibility, whether I want to use that income or just plug it back in, reinvest, and carry on. So that's one reason. I can get into other reasons, but that's kind of simply put why I really like CoveredCall ETFs. It gives me flexibility to how to use a portion of that return. Okay, now let's get to asset allocation. There are 2 accounts that we can discuss with the different asset allocations. The first one, very boring, is my wife's spousal RRSP. Now, again, with passive, you can set a target if you have multiple funds in the various accounts. It's not gonna buy anything for you. It's basically what this platform is, or passive. It's just a read only. So it has access to your account in a read only format. It just reads whatever numbers are in there. So if you set a target, it's not gonna automatically buy anything or sell anything for you. But you'll set a target, and then I'll tell you what you need to buy to actually get there based on the dollars you have in that available dollars in that account. So in this one, I just have HYLD.U, and it's just one fund. Again, for those who are newer, I actually had XYLD from August of 2022 to August of 2023 in this account. XYLD, as I was kind of gaining more experience with and understanding my own needs, XYLD no longer fit that format. I really wanted to have more growth along with the income, and XYLD was just not the right fit for me, so I sold it. HYLD was meant to be a placeholder, and ironically at the time, funds like XYLD were inside of HYLD.U, but HYLD has undergone some tremendous change and I would say, is by far the best growth oriented all-in-one CoveredCall ETF out there, meaning an ETF that invests in other ETFs. I just think it is equipped well to grow for the long term, both in price appreciation along with total return. So pretty boring fund. There's nothing really more to discuss there. I have the Spousal account. It was set up with the intent not to actually hold it long term. It was just meant so that that one day, once I stopped contributing to it for about 3 years, my wife could start extracting money from it, and it would come out at a much lower tax rate. So we stopped contributing to this account in it was last year. So last summer we stopped. So basically by the summer of 2026, I'll probably take out half this amount, and then in early 2027 I'll take out the rest of it and just put it into a non-registered account, and that'll go towards various expenses that we have. Okay, so that's really the goal for this, is just take advantage of the lowering my tax in my tax bracket for now, and then eventually take it out of a much lower tax bracket later. So it was only meant to be a near term kind of account to have. Okay, next up we got the more interesting portfolio, which is the TFSA. It is getting close to being maxed out. I'm probably about $5,000 away from maxing out, but with the end of the year coming and with more contribution room coming, roughly around $7,000 heading into 2025, I suspect I'll have, by the start of the year, maybe $9,000, I guess, by that point in room that I can use up. And basically, anyway, this portfolio has undergone change as well this year. I used to have a bunch of sector funds in here like ENCL, HMAX, BKCL. I also had UMAX. So all those funds I really like. There was nothing wrong with them, but I always wanted this account to be much more American focused. And I get that with basically all of these funds. So these are ETFs that invest in other ETFs, very diversified across geography, strategies, asset classes, leadership experiences and anyway, so it just makes for quite the dynamic mix. I also wanted to achieve what is the maximum yield that I can get with the maximum potential price appreciation? Like, what is that max? So what I'm finding out here in 2024 is that's probably around 10 to 12% is roughly where that yield can be. And you still get some really good price appreciation. Like I said, we're going to get to performance of the portfolio very shortly. That's in this tab up here. So basically, the big growth drivers, I would say, are HYLD and one sector-specific fund, which is HTAE, which harvests stock selects about 20 different companies. And unlike the NASDAQ 100, which is tech heavy, this is just a pure tech play, 100% tech. Whereas, again, everything else, this is pure USA. HDIV has about 75% Canadian stuff, 25% American. HDIV is mostly American, but overall North America focused. EQCL, globally focused. Essentially, EQCL is like half of it is USCL, and then like another 20-ish % is CNCL, and then there's a little bit of a mix of developed markets and some emerging markets as well. And then BMAX, I just like to call this thing the steady buoy of the portfolio. I find that it rises well in good markets, and then when the market has a little bit of a trouble, it just seems to kind of buoy. It doesn't seem to, if it goes up, maybe it goes down a little bit, then it goes up, and then anyway, so done well with that. So Passiv just gave out on me here, loading, but anyway, there's really no cash in there, but this is the part where I was just mentioning how it will tell you exactly what to buy. I'll never tell you what to sell, but as you have money in, it just tells you what you need to do to reach your targets. So right now, my accuracy is around 100%, and then you can see where the actual investment dollars are. So my max is 20%, but Right now, I'm a little bit overweight in it, which is not a big deal. And then we have HTAE here, which is a little bit slightly underweight. But overall, it's within very normal parameters. Okay, so that's it for asset allocation. Let's get into some more fun stuff here. So we're over in Wealthsimple now, which again, it's another tool that you can link your accounts to, and it gives you a pretty good 360 overview of your entire portfolio, from income generation, also performances of your portfolio individually and as a whole portfolio. This is one thing I like to show here. So basically, I joined Wealthsimple around early January of 2023, and then as we go along, we can see how my portfolio, through contributions and reinvesting, how it's grown over time, along with, again, price appreciation from a total return perspective, and how that has grown in almost 2 years. And from $110,000 to almost 2 years later, to roughly around $220,000 now. So continues to grow well. No matter what the market conditions are, I just reinvest, dollar cost average, keep it simple. I'm not worried about, should I invest in a particular fund if it's over a certain price? I don't care about any of that. That stuff does not matter to me. I don't think it actually will matter. Heard a good quote, or I saw a good quote, I should say. I forget where exactly I saw it, but I'm going to use it when we see these little blips. Basically today's highs are tomorrow's lows. Really like that quote, and it's so true, because at one point these little dips, as you zoom in, we're probably really big anxiety based days, but then when you zoom out, you kind of there's just more perspective, right? Markets are going up, ideally, over time. And these are just the little bumps along the way, okay? There's really nothing else to show here. Let's just go into, again, the main course, which is individual fund performance. So if we head back here, this is all the accounts. And if we filter this by total return, so price appreciation plus income generation from every single individual account, you will see that HOLD is up 34.91%. Total return based. I will give this one a bit of an asterisk, just because HOLD inside of my TFSA was everything at one point. So I had to sell off. So it does kind of skew the numbers a bit, but everything else I've never trimmed down. I've just added to. So HOLD.U, I've owned it for a little over a year, probably about 14 months at this point, up, again, 26.93%. Awesome there. I would expect HTAE to do really well. I would say, of all the tech funds here in Canada, or at least Canadian funds that invest in the tech sector, HTA, I believe, has the highest price appreciation. Maybe not necessarily on a total return basis, but at least that on a price performance level. So that's going to give me options in the future. There is certainly, I would say, a good shot that at some point, depending on how well it does, sell HTAE off and put it into the remaining all-in-ones at some point in time. So there is that potential. I've kind of toyed around with that idea, but again, that's not going to be happening anytime soon. And one of the other benefits with having or maybe more of a balanced approach, or thinking about having CoveredCall ETFs that can grow, is that as their price grows, there is a much better shot that the distributions are going to grow as well. So for instance, if you have a CoveredCall ETF that has a policy that they'll write 30% of coverage on the fund, as the price rises, that original 30% on say if the fund started at $20 but then rises to $21 and then $22 and that original 30% is going to start to right? It's essentially you're writing less and less and less as the market is rising. So if you want to return to that 30%, you will get a higher premium for it. So you have a better shot at natural distribution growth over time. If you believe markets are going to go up over time, you want to be invested for the long term. That's why I'm not afraid to use leverage funds. And a lot of these are leverage. Well, it's HOLD, HTAE, HDIV, BMAX, HDIV, EQCL. They're all leveraged by about 25% naturally. So for that leverage, a little bit more expensive, but with interest rates coming down over the next year or so, we should see much lower MERs, because right now I want to say on average you're getting around 2.5% versus, again, the low fee broad market base S&P 500 style ETFs like VFV, which are, I think the cost, at least the management fee is around 0.09%. So there's costs there associated with it. Anyway, let's get into the rest of the performance here. Total return wise, I've held most of these ETFs for a little over a year now. I think HYLD is probably the oldest one at around 2 years. I've held it for HYLD.U for 14 months, and everything else is roughly around a year. And EQCL I bought, I want to say early summer. So it has the lowest just because I sold off my sector funds, got into that, and then distributed the rest of that money across all of these other all-in-ones. And right now my geography diversification is probably around close to 70% American, 20-ish% Canadian, 8% developed markets, and around 2% emerging markets. So anyway, we saw all that. Let's go into power-ups, and we're going to look at performance. So now we are looking at my portfolio performance, all of them combined, total return versus every other index. Now, it has been believed that CoveredCall ETFs, they'll underperform the market, meaning the S&P 500, which is typically the standard benchmark index when people refer to beating the market. But over the course of this year, this portfolio, albeit in and around the summertime, was matching pretty much everything else. But as we got into mid-September, October, to my surprise, this portfolio has really pulled away. And even though we've seen some drops recently here, it still is outperforming by a good few percentage points. Now, the reason I believe that this portfolio is outperforming everything else is because that some of the ETFs are much more concentrated. So the idea here is if you invest in, say, one company, again, depending what that company is, you can see some amazingly outsized gains because it's just one thing, versus if you had, say, 1,000 things in one fund. Naturally, that's gonna slow down just how much you're able to grow, but it also minimizes the impact of any kind of loss, which again, you probably want to take up if you are just someone who's busy, maybe doesn't have the knowledge, experience yet. Start with something that gets your feet wet, and then maybe take on more of a hybrid approach once you kind of understand what it is you want from your goals and your budget and your time frame, whatever that looks like. So even recently, you'll see that my CoveredCall portfolio took, I would say, more of a drop than everything else. But again, that's because some of these funds have a stock selection process. So they're diversified amongst stocks, but some of these funds only hold, like, say, 20 stocks inside of them, versus, say, the NASDAQ, 100 things inside of it, S&P 500, 500 things inside of it. Anyway, so what goes up must come down, and I believe it has more to do with HYLD more than anything, because HYLD.U and HYLD, they hold a much larger weight overall across both accounts. They have more of a stock selection process. So those two funds alone really impact the performance on the upside and the downside. And HTA on a secondary level also contributes mightily to growth, but also in times like this where it takes a bit of a slip. But nonetheless, doing really well. I was shocked. I'm just happy if I get a 10% return every year. So anything above that is just a bonus for me. Really happy with how it's been performing so far. So we've looked at price performance. Let's get into income. So right now we can see exactly how my income has actually grown month over month over the past year. So in November of 2023, I started at around $1,495. And where exactly has that gotten to today? You can see that some months it might have only gone up maybe $30. Some months it went up by $100. But basically today it's gone up to $2,100. And it was at around almost $1,500. So we can see that that's basically a 35% increase over the past year alone. A lot of that has been, again, just contributions on my end, reinvesting, but also a big chunk of that is just natural distribution increases. I think if you were to average out all my funds, and you made it equal weight, 20% across the board, on average, my distributions would have increased around 14.5% overall. So anyway, has played a massive role in that. So investing with a capital appreciation mindset has its advantages. The only disadvantage with it is part of that return is not going to work for you, which I mentioned at the top of the video, right? Which is what I like about CoveredCall ETFs is, again, a part of that return is coming back to you month after month, and you can get it working for you right away. Whereas with the total return approach, those dollars are locked in basically for life until some time down the road. And so anyway, there's that portion that is not working for you. Whereas take on maybe some higher yields that don't have that, say, natural price appreciation effect built in, but at least you get the dollars working for you right away, or the majority of those dollars working for you. But I like to see green and growth in the portfolio, and so that's for those who maybe appreciate the psychological warfare that the market can pack some punches your way. And I just overall just want to be able to still see a little bit of green in the portfolio. Okay, so we've looked at income, we've looked at performance. Let's look at how you can stay kind of tapped into my portfolio, because I only plan on doing these about once every quarter. The next one I'll probably do is in February. I only do videos once a week, so I don't really want to dedicate one video on our portfolio every single month. I mean, you guys absolutely love them, and I do. I like doing them as well, but I also like talking about other things and learning new stuff and being able to share that with all of you. So, but another good way of just staying in a light way involved is if you subscribe and obviously hit the like button and all that. It gives it broader reach, and it's a simple, easy, and free thing to do. But it'll also keep you informed on the performance of my portfolio. I'm now every Saturday I post this weekly portfolio performance post. They all look like this. How much has my portfolio gone up and against all the other indexes, and then you get some other good stuff in there too, some statistics, what's going on with the channel, and it's just at a quick glance you can see just exactly every week how much it's grown. Every month I post how much my income has grown as well in this income report post, and then going back all the way to basically the start of the channel, you can see that my income really bounced around a lot because of XYLD variable distributions, but I wanted to stabilize that and just see that growth month over month with no more variations in the distribution. So you can also see how much income I made last year, how much income so far I've made this year. And there's obviously other news and things I post in here, like workshops and one-on-ones, availability. My AllStar tracker, the tool I'll show off in a little bit here, as something if you're curious or interested in, you want to really kind of jumpstart more of your or further your CoveredCall ETF investing knowledge. That's a good way of doing it. Along with that, it's also taking advantage of the one-on-ones here. Like if you click on that, maybe you're curious, maybe you need just a little extra help with figuring out portfolio and just whatever questions you have. These, I got to say, you can't see it here, but I have another availability on, it's like the last day of November. It's on a Saturday. But the information that I talk about here and some other YouTubers talk about, this is not something that someone at a bank is going to be able to well describe. So from my perspective, if you are to do basically a one-on-one coaching thing with me, what you're paying is to jumpstart, further your knowledge, get my, experience investing in these things, because I've almost been doing it for about 3 years. And one of the great things about it is it's from one DIY investor to another, right? I'm speaking to the teachers, the janitors, the other tradespeople out there, just like myself. I'm a pipe fitter that really enjoys talking about finance. So if you're interested in that, all you really need to do, click on the link, click on one of these availabilities. You just click on time, hit next. If you got questions, email your name. It's by credit card. I don't see any of that info. And basically many YouTubers use what's called Calendly here to book to one-on-one coaching sessions, highly regarded amongst the YouTube community that teaches other people how to strategize on YouTube. And then it's powered by Stripe, which is, again, another means of just payment and very high regarded. So I would use it myself. If I was booking a one-on-one, I mean, what am I going to say? But I would honestly use it. So if you feel like you need a little extra help, there's something there that you could take advantage of. And again, if you are someone who's looking to actually build a portfolio, stay on top of CoveredCall ETFs, I have this awesome tool that I started building about a year ago, and it launched on January 1st of this year, but it basically gives you all of the Canadian CoveredCall ETFs that are out there, all of the US CoveredCall ETFs that are out there. It gives you performance against indexes. There's also a ton of info on just distributions. I have new tabs now that basically will show you my portfolio, so you can stay on top of all that, whatever that looks like. And even my trades, it's now available. So if you wanted to filter through all this and see how much I've contributed, see how much I receive in dividends, and you can filter through all that, and you can filter my buys, my contributions, dividends, my sells, all of that good stuff. So it's just another way of transparency, give you guys another layer of just seeing exactly how my portfolio is doing on a daily basis. Also have a yield tracker showing what were the yields at the end of every single month and how have they changed. Keeping track of AUM, how has AUM changed? This is an important metric for the health of any fund you want to stay on top of. I also got average volume, distribution tracker, how much distributions have increased month over month, year to date. I also have just a thing on taxes as well. So yeah, a lot of information in here. Again, this is even in a one-on-one, if you need help kind of filtering through this, help build a portfolio based on some of the information you see here. And like the tax tab is dynamite, absolutely dynamite. I filtered it not just based on dollar figures, but percentage as well. So great tool. This is known as the full tracker. There's 2 different tiers in my Patreon to pick this up. So the full tracker has all those tabs that you saw, whereas the partial tracker has the Canadian, the USA tabs, plus the ones that track my portfolio, which you can see here, $5 a month for the partial tracker and $13 a month for the full tracker if you want that. All right, so we've looked at all that. let's get into tangible use cases for a CoveredCall ETF based portfolio. Now, here's some really interesting stats that I think you guys are going to like. Now, one thing that next year, in the next 6 to 10 months roughly, my family, we're planning on selling our condo and we're going to rent a house. To me, my dollars actually go a lot further with renting versus buying. I have no hope in owning a house in my target neighborhood. If I want that, I need to move somewhere farther, way farther away, where my round trip to work would be like 4 hours, 4.5 hours, maybe even 5 hours, but insane. Even a townhouse is at levels that I still think are crazy. Like even if they were $300,000 cheaper, I still think it's all crazy. So for me, CoveredCall ETFs are probably the best way. Take equity out of my home, put it in a non-registered account. Roughly, I'm expecting on the low end, I would say at minimum $150,000 that I can just put to work to offset the cost of a rental. I'm looking at a max of about $4,000 a month. And every so often I look around at what's available, and every so often I find something and I show my wife. She really likes it. She wants a yard. There's a little workshop in there, patio, again, yard we can have for the kids. 5 bedrooms. Like it's just a quaint older home. I'm fine with that. That's like when my wife and I got married, that's what we kind of expected we'd probably live in, which is like a 1980s style build. But boy, did that dream disappear quite quickly after we dropped. I would say 2016, that's where things really took off. I know we're going to say COVID, but it really took off in 2016, at least in my target neighborhood. So, by the way, I know if you hear the term rent, house, up to $4,000, that's like insanely expensive. But when we are taking equity to offset those costs, we basically we're not actually paying anything really more. Our costs would actually stay roughly the same, but we gain massive square footage. We live in roughly, officially it's probably about 900 square feet, but we've been able to extend the life of this place by turning our deck into an extra bedroom or a flex room. So we've probably pushed it closer to, unofficially, maybe 1,100 square feet. But here we got a 2,600 square foot home, and at $3,700 a month. And in my opinion, this is actually a pretty fair deal for leaning to the side of like a good deal as far as what I'm seeing here. So I've also have a couple other tabs up here looking at the cost of rentals. Now, this is where the interesting stats come in, because I think this is something I haven't shown on the channel before, which is comparing the cost per square foot versus, say, a basement suite versus the payments to own an actual house, the cheapest house you can buy in my target neighborhood. So right now, I was looking at kind of the average prices, and I found this one was the best and the one I actually really like. So at $3,700 a month and at 2,600 square feet, that works out to a cost of $1.42 per square foot per month. And then we got a bunch of, I would say, basement suites in a really competitive price range, which is $1,600, $1,500, maybe to $1,800, 2-bedroom, kind of 800 square foot. But I went with around $1,600 divided by 800 square feet will get you actually $2 a square foot. So on a per square footage basis, and it does make sense, you're actually paying more for the basement suite. Now, it's more competitive at this level, naturally, just because it's just cheaper. Incomes are, they're just simply less overall compared to, the amount of the pool that can afford, say, a $4,000 a month payment for a rental. So you got upwards pressure on rents that are in this kind of range here. So the rents can be pushed up, whereas at this level, not a lot of competition. There is no rental crisis at this level. But at this level, depending where you are, yeah, there's a lot more pressure. Okay, so we looked at this one, the house. It's about $1.42 a square foot. At the basement suite level, it's about $2 a square foot. Now, home ownership. If I was to buy a house right now, which is this nice, big, beautiful home, it's almost $2 million. Absolutely insane. I'm not paying that much money for some. Again, it's nice. Sure, I'd live in it. If I had, oodles and oodles of cash. Why not? But that price is just insane to me. Again, you're getting 5 bedrooms, 4 bath. The payments with 20% down on a $2 million home is this excruciating, suffocating amount, $8,842. It makes me, I'm just sick when I see this. And especially knowing that people are just scraping to try to afford the house just to say, I own a house. In my opinion, so what? So at $8,842, if we divide that by $3,232 a square foot, you are paying per month $2.73 a square foot. So let's just factor this in. I can rent a place that is, it's about 600 square feet smaller, but it costs $1.42 a square foot per month. Versus this with 20% down, which is $2.73 a month. That imbalance, I think those simple numbers speak for themselves. Now I get it. Rent versus owning, that is a deeply personal choice if you want to build equity in a home. Personally, again, I'm much more of a bigger fan of diversification. Owning a home is just one thing. I would rather put my ownership in units or shares of something that's well diversified, so I own pretty much everything across the economy. I still own something. It's just not a physical, tangible asset. So that is certainly a hurdle to get over, and that has for me, especially because, for those who don't know, in the 2010s, I spent a lot of time working on real estate projects with my family. So the idea of home ownership is very much ingrained in the DNA of my family, and that has certainly been definitely pushed in my earlier years, my late teens, early 20s, mid 20s, like own. But with time and with kids, and as I've come to understand my own goals, my own financial situation with my family, this is by far the best way for us to go to get more with less dollars. And in this economy, in this country, that is a rare thing it's a rare feat to be able to go for. So stay tuned to the channel, stay subscribed. I will actively be talking about this process. I know many of you have reached out to me and have asked me, will I talk about that? Of course I will. I talk about it in all these overview videos. I was also thinking that I'd eventually do like a tour of my current condo, and then, I'd closing the door on this place, and then, the next frame you'd see me like opening the door on the new place. So I kind of want to maybe do sort of at least one video that's a little more higher quality, and it's more of sort of a lifestyle video of like, this is what cover calls have allowed me to do. So with patience, with learning and understanding my own situation, this is what I'm going for. It's exciting to share this with you guys, and hopefully many of you have stuck around for the length of this video. I know these videos can sometimes get a little long, but this is kind of where this value can take you. And that's something personally I want to prove. It's not the main mission of the channel to show my personal journey. Ultimately, it's to show you how these funds work and just speak about CoveredCall ETFs overall. But as a secondary objective. It's to show, yes, this is how it's working in my own life. I'm not just talking about these funds and not investing in them. I'm absolutely invested in them. And I'm really happy I made that switch. So we'll see how all this plays out over time. So as always, if you like the video, hit all the buttons of the like and subscribe variety, and I will see you all in the next video.